markets. Now, Kenya's central bank governor remains confident that the country's forex reserves are adequate to handle any future shocks that may hit the country's economy, despite a decline of over 16% in the year to date. Now, as the governor, Dr. Patrick Njoroge, closes in on his first 100 days in office, CCTV's Ramah Nyang looks at what has changed in Kenya's monetary policy.
Thank you very much, Uche. Let's start with the Kenyan shilling's performance against the dollar so far this year. The dollar's up about 16% against the local unit in this part of East Africa. But at one point in July, it actually slid very quickly. In that month alone, the dollar was up 3% against the Kenyan shilling. Since then, however, things have changed. There's quite a bit of stability back in the markets. The shilling actually has stabilized at around 105 to the American dollar. And a couple of reasons why that has happened. The most prominent of those, however, is the sheer draining of liquidity from the market. Overnight lending rates, if you use that as an indicator, have shot up to about 25%. This, historically, for the Kenyan market, is very, very high, painful, as a matter of fact. But this, however, is not the only thing the central bank has done under Dr. Patrick Njoroge in order to impose a bit of discipline into the market. And that's a word he used a lot earlier today, imposing market discipline, not just on currency dealers and treasury desks, but also apparently on us guys, the media.
Where you have an analyst out there, he mentions that there's a particular we'd say that he expects the exchange rate to hit a particular level, and then it's quoted in your newspapers. I mean, it's quoted in your reports and so forth, and that begins to lead to some sort of hard behavior and indeed some sort of self-fulfilling expectations. This is very dangerous. Moving
forward, however, the challenge facing the central bank is one of balancing monetary policy with fiscal policy. The problem he faces, frankly, can be summarized in a single chart. These are the budget outlays for the last 4 or so fiscal years, including the one we're in right now. Every successive year, we're seeing a jump of about $2 billion in spending, despite claims by finance ministers and presidents that we need to consolidate our spending and to cut our spending. That's the rhetoric, but it never happens. And at the same time, as we just mentioned, monetary policy is getting tighter and tighter and tighter. That's a problem that cannot continue forever. At one point, as the governor put it, something has definitely got to give.
The way things are, it's as if we have a very, let's say, loose fiscal policy, it would be and a very tight monetary policy. It would be that it's the equivalent of having, the old cars that I think all of us learned to drive in, with 2 pedals, 2 sets of pedals, one in there. So you have one person with his foot flat on the accelerator and the other person with his foot flat on the brake, firmly on the brake. Clearly something's gonna give.
Now, of course, he did say at the end of today's event that the central bank and the Treasury are both working together on ways to consolidate spending and also bring fiscal policy in line with the objectives of monetary policy. He did not, however, provide any specific details on exactly what ideas are being bounced around between those two departments. But as always, we'll keep tabs on that story and bring you the latest developments right here on Global Business. For now, though, back to you, Uche.